markets are down with absolutely no signs of looking up again anytime soon. Don't you just kick yourself? 2 years ago, you could have sold and made so much of money, but you didn't.
Extensive research shows that we hate to take money calls. Status quo is just so comfortable. If that sounds like you, listen up, for we have just the products for you.
Most of us simply hate to sit down and take a long, hard look at our portfolios, especially now when it's bleeding so heavily on stocks and equity mutual funds. But jog your memory a bit. Each one of us, as long-term investors, was making a pretty neat profit a year and a half ago. But we just sat pretty, happy and pretty. And today, what are we doing? We're still sitting, unhappy and not so pretty. The economic meltdown this time around is a nasty reminder of a painful gap in our investment efforts, and that's the ability to rebalance our portfolios and stick to our asset allocation. So today, we will look at Lifestage Mutual Funds. What are these? And more importantly, are these the answer to the biggest investment handicap we face, rebalancing? Rebalancing. Both of us also, I think, have promised each other and ourselves that we will churn and we will look at our portfolios, but there's just absolutely no time. There's time to do everything else but rebalance your portfolio.
Yeah, also I think we need to understand, especially in markets like this, where the whole concept of equity is coming into doubt, but equity as an asset class which will build wealth will work only if you do three things, which is invest regularly, make an asset allocation, and rebalance your portfolio. Now, these first part, I think we are still doing because of the systematic investment plans.
Right.
People have got used to it. Second and third, I think we are still at grade E rather than moving towards grade
Not
B.
even pass.
No, we're not even passing because asset allocation is still so heavily skewed towards debt. So asset allocation is simply the ability to split your savings between different buckets: debt, equity, real assets like real estate or gold. That is asset allocation. And the third part of it, which is, I think, the most important, especially because we've seen the market 2 years back, is the ability to rebalance your portfolio. Rebalancing sounds like a technical word, but it is so simple. It's almost like profit booking. In 2004, suppose you had a 50-50% asset allocation. Suppose you are happy with 50% equity and 50% debt. By 2007, without you doing anything different, this ratio was at 70-30, which means the rising market took the value of your stocks from 50% of your asset allocation to 70%. Remember, debt doesn't grow so dramatically as equity does as an asset class. So you have seen, you are now in 2007, you are now at 70-30. What did we do? Nothing. We kept
thinking it's going to become even bigger.
Yes, that's greed. That's greed. So at that point, when you are at 70-30, but remember, in 2004, you were happy with 50-50. So should you be suddenly changing your asset allocation towards a riskier portfolio? You shouldn't. That is the time that you rebalance your portfolio, which means sell equity and buy debt, which would mean PPF, fixed deposits, bonds. None of us could do it. In 2007, I didn't, Manisha didn't, I don't know anybody who could do it, simply because investing is such an emotional issue. We hate to sell the asset class which is growing because everybody around us is making a killing.